A solar panel factory in China consumes more silver in a single day than a medieval kingdom held in its entire treasury. Yet scroll through YouTube and you will find breathless thumbnails screaming, "Silver to $100" or the coming silver apocalypse. The price has doubled in 2025, hitting an all-time high of $59.32 per ounce in December. Central banks from Russia to Saudi Arabia are quietly accumulating. The green energy revolution devours this metal at a pace that mines simply cannot match. So which is it? Is silver the indispensable metal of our technological future, or the latest target of financial speculation? Today, we investigate the hard data on industrial demand, mine supply, and market dynamics to separate fact from fiction. This is not investment advice. This is forensic journalism. We will examine 3 critical questions in sequence. First, what is driving unprecedented industrial demand, and why did the United States designate silver a critical mineral? Second, can markets adapt through substitution, recycling, and new supply to deflate the crisis narrative? Third, when we weigh all the evidence, what verdict does the data actually support? Let us begin with the bull case, the crisis narrative. In 2020, the United States Energy Act officially designated silver as a critical mineral for the first time in American history. This was not symbolic. It carried regulatory weight and signaled national security concerns about supply chain vulnerabilities. The Department of Interior defines critical minerals as those essential to economic or national security with supply chains vulnerable to disruption. Silver qualified because 72% of global production comes as a byproduct of mining other metals like copper, lead, and zinc. According to the Silver Institute's 2025 World Silver Survey, only 28% of silver comes from primary silver mines. This means silver supply cannot respond quickly to price signals because production decisions depend on demand for entirely different metals. G20, China, Australia, and multiple European nations have followed suit with their own critical mineral designations. The geopolitical message is clear. Silver is no longer just a precious metal, it is a strategic asset. Now let us examine what is consuming all this silver. According to the Silver Institute, global silver demand reached a record 1.2 billion ounces in 2024. Industrial fabrication alone hit 680 to 700 million ounces, an 11% increase from the previous year and an all-time high. Solar photovoltaics have become the single largest industrial consumer of silver. In 2024 alone, solar panels consumed 232 to 244 million ounces of silver, nearly quadruple the 60 million ounces used in 2015. Each photovoltaic cell requires approximately 111 milligrams of silver paste to capture and transport electrons generated by sunlight. Global solar capacity doubled from 1 terawatt in 2022 to 2 terawatts in 2024, according to the International Energy Agency. China alone increased its solar capacity by 45% in a single year. The International Energy Agency projects annual solar installations could reach 1,000 gigawatts by 2030, nearly doubling current levels. But solar is only part of the story. The electric vehicle revolution is creating an entirely separate demand surge. A traditional internal combustion engine uses 15 to 28 grams of silver. A battery electric vehicle requires 25 to 50 grams, and some new solid-state batteries could use up to 1 kilogram per vehicle. Samsung's new solid-state battery technology incorporates a silver-carbon composite layer that could dramatically increase per-vehicle silver consumption. Electric vehicles represented 18% of global car sales in 2023. Up from just 4% in 2020. Projections suggest EVs will exceed 60% of major market sales by 2030. The automotive sector currently consumes approximately 80 million ounces annually and is expected to exceed 90 million by 2026. Then there is electronics. Every device with an on-off switch contains silver. Silver's unmatched electrical conductivity makes it essential for circuit boards, contacts, switches, and increasingly AI data center infrastructure. As Michael DiRienzo, CEO of the Silver Institute, stated, anything that has an on or off switch needs silver. Now here is where the bull case becomes genuinely concerning. The silver market has been in structural deficit for 7 consecutive years. According to Metals Focus data cited by the Silver Institute, the 2025 deficit is projected at 117 to 215 million ounces. Total annual demand of 1.2 billion ounces confronts total supply of approximately 1 billion ounces, including recycling. That gap of 200 million ounces must be filled by drawing down existing inventories. And inventories are collapsing. COMEX warehouse stocks have declined 23% since September 2025 alone. Shanghai Futures Exchange inventories have fallen to their lowest levels in a decade. Total visible exchange inventories have dropped by approximately 480 million ounces since February 2021. The supply side offers little relief. Global mine production stands at approximately 820 to 844 million ounces, having increased just 2% in 2024 despite record prices. In fact, silver mine production has declined 7% since 2016. New mining projects take 5 to 10 years to develop from discovery to production. Only 9 new facilities are projected to add 44 million ounces over the next decade, according to CPM Group. Ore grades at existing mines continue to decline, requiring more rock to be processed for less silver extracted. A peer-reviewed study published in Science Direct in August 2025 concluded that by 2030, supply may meet only 62 to 70% of projected demand. The researchers noted that since 72% of silver is produced as a byproduct, significant expansion of primary output by 2030 is unlikely. This is the structural crisis the bulls are describing. Demand accelerating while supply remains fundamentally constrained. Bloomberg data confirms record silver inflows to London in November 2025, tightening supplies in other global hubs. Silver-backed ETFs added approximately 200 tons in a single day recently, lifting total holdings to their highest since 2022. When physical shortage meets investment demand, the conditions for a price spike are created. That is the bull case. A genuine structural crisis driven by irreplaceable industrial demand confronting inelastic supply. But wait, every market has two sides. Now we must examine the bear case, the argument that this is all hype. When prices rise, engineers get creative. The phenomenon is called thrifting, using less of an expensive material per unit produced. In 2009, each solar cell required 521 milligrams of silver paste. Today, that number has dropped to approximately 111 milligrams, a reduction of nearly 80%. Philip Newman of Metals, Focus in London, argues that high prices will accelerate this trend further. At $30 an ounce, margins get pressured, so solar panel manufacturers in China and India begin looking for substitute components. Copper and aluminum can replace silver in certain electronic applications, where maximum conductivity is not essential. Jeffrey Christian of CPM Group has stated that current deficit estimates are exaggerated precisely because they ignore this adaptive capacity. He notes that the world has plenty of silver reserves and that panic narratives consistently underestimate technological response. However, here's the critical counterpoint the bears must address. New high-efficiency solar technologies like TOPCon and heterojunction cells actually require more silver, not less. The efficiency gains that reduce silver per cell may be offset by technologies that increase silver loading for better performance. This is the substitution paradox. Sometimes better technology consumes more critical resources, not fewer. Now let us examine the often ignored source of silver supply: recycling. Every smartphone, laptop, and solar panel contains recoverable silver. When prices rise, the economics of extracting that silver improve dramatically. Scrap silver currently provides approximately 20% of annual supply. That is roughly 180 to 200 million ounces, recovered from industrial waste, old jewelry, and electronic scrap. At higher prices, marginal recycling operations become profitable, potentially unlocking significant additional supply. The bear argument is straightforward. Above-ground silver stocks are massive compared to annual mine production. Estimates suggest billions of ounces exist in jewelry, silverware, and industrial applications worldwide. High prices could theoretically unlock this vast reservoir through increased recycling activity. But there is a catch. Much of this silver is dispersed in tiny quantities across billions of devices. Collection infrastructure remains inadequate in most regions. And recycling takes time to scale. Building new facilities requires capital investment and years of development. The deficit is happening now. The recycling response may arrive too late. Now we enter the most contentious territory, the paper silver market. The price you see quoted for silver is not determined by physical supply and demand alone. It is heavily influenced by futures contracts traded on exchanges like COMEX, where paper claims on silver vastly exceed physical inventory. Speculator sentiment can drive prices higher or lower for extended periods regardless of physical fundamentals. In 2020, the gold-silver ratio spiked to 125 to 1, the highest ever recorded. During the COVID panic, that extreme ratio had nothing to do with industrial demand. It reflected pure, fear-driven capital flows. The bears argue that much of the silver's 2025 rally reflects speculative positioning, not just physical shortage. CME Group's 2025 analysis notes that silver options trading volumes reached all-time highs. Weekly options now account for over 20% of total silver options volume. enabling precise bets around macro events. When sentiment shifts, these leveraged positions can unwind violently, crashing prices regardless of physical tightness. History provides sobering examples. Silver has crashed 40% or more on multiple occasions, even during periods of industrial demand growth. The 2011 peak near $50 was followed by a multi-year decline to below $14. Many investors who bought the crisis narrative then waited over a decade to break even. The bear case concludes, yes, physical fundamentals are tight, but market mechanics and sentiment remain the primary price drivers. Extreme price predictions like $200 per ounce assume sentiment and fundamentals will align perfectly. History suggests that alignment is rare and temporary. So where does this leave us? We have examined compelling evidence on both sides. Let us now conduct a forensic analysis, weighing each factor systematically. First question, is the demand growth sustainable? The evidence strongly supports continued industrial demand acceleration. Solar installations are projected to nearly double by 2030. Electric vehicle adoption shows no signs of reversal despite policy uncertainties. AI and data center expansion creates additional demand vectors not present 5 years ago. Verdict on demand? Strong and likely to strengthen. Second question, can supply respond adequately? Here the evidence is less favorable for the bears. Mine production has been flat to declining for nearly a decade, despite record prices. The byproduct structure of silver mining fundamentally limits rapid supply response. New mining projects require 5 to 10 years from discovery to production. Recycling can help at the margins, but cannot fill a 200 million ounce annual gap quickly. Verdict on supply response, slow and structurally constrained. Third question, what about substitution and thrifting? This is where reasonable people can disagree. Thrifting has reduced silver content per solar cell by 80% over 15 years, but new high-efficiency technologies may reverse that trend. Substitution is possible in some applications, but silver's conductivity remains unmatched for critical uses. Verdict on substitution risk? Medium, with significant uncertainty. Fourth question, is speculation distorting the price signal? Almost certainly yes, to some degree. Record options volumes and ETF inflows suggest significant financial demand beyond industrial consumption. But here is the crucial insight. Speculation amplifies underlying trends. It does not create them from nothing. The physical deficit is real. The inventory drawdowns are real. Speculation may determine the timing and magnitude of price moves, but the direction is set by fundamentals. Verdict on speculation. Significant short-term influence, limited long-term impact on direction. Let us return to our central question. Silver's critical mineral status, real supply crisis, or just hype? The evidence points to a genuine and tightening physical market. 7 consecutive years of deficits. Industrial demand is accelerating across solar, EVs, and electronics. Supply is structurally constrained by byproduct dynamics. Inventories at multi-year lows and falling. Central banks are beginning to accumulate for the first time in decades. This makes the crisis label credible for the coming 2 to 3 years. The extreme price predictions, the $200 forecasts, the quadruple-digit speculation, these are often hype, fueled by sentiment that ignores the long-term adaptive capacity of global markets. Markets have solved apparent crises before through substitution, efficiency gains, and new supply discovery. The $200 thesis requires everything to go right for bulls. Sentiment alignment, no substitution breakthrough, continued policy support, and inventory exhaustion. That is possible, but not probable in the base case. A more measured conclusion, silver faces a genuine multi-year tightness that supports prices materially above historical averages. $50 to $80 per ounce appears well supported by fundamentals. Beyond that, you're betting on speculation and overwhelming adaptation. That bet has historically been a losing proposition over the long term. So what is your verdict? Vote in the poll appearing on screen now. Crisis or hype? And debate respectfully in the comments. Bring your data, challenge our analysis, add perspectives we may have missed. If you value deep dive investigations like this, subscribe to the channel. Our next report breaks down the Federal Reserve's historic policy pivot and what it means for your portfolio. Until then, question everything, verify the data, and make decisions based on evidence, not emotion.